Is one of the great debates currently, because politicians always try to say, hey, the economy is doing phenomenally because look, markets are actually rewarding our policies.
Right.
But it's been a long time since the market has actually discounted what the real economy is doing. And it's very simple. The level of impact of monetary policy after the monster liquidity injections and negative real rates, plus the quantitative easing processes, all of those have generated a completely different market dynamic compared to what we see in the economy, to the point where you and I remember the time in which bad economic data meant a bad reaction from markets. But now what we get is when economic data is negative, markets actually get excited because that means more money printing, okay? So this is what we need to understand. There's been very few markets in 2023 that actually reflected the reality of the economy. And the only one actually that did was China, because because monetary policy was contractive at the same time as the economy was contracting. No? So what we need to understand is that multiple expansion, the level of risk that markets take, are direct consequences of monetary destruction. Is ultimately, it's not necessarily that markets are booming. It is basically that the currency in which those markets are priced is losing value and is losing purchasing power. So that explains why the 60-40 portfolio has died as a means of hedging economic cycles, because bonds and equities are massively correlated for that reason, for the reason that I just mentioned, the incredible level of impact of central bank policy in markets. Therefore, the reason why we need to pay attention to the real economy and to macroeconomics is because there is a very significant divergence between asset classes depending on the level of impact of that monetary policy on each stock. No? For example, we have seen at the beginning of 2024 a staggering 20 profit warnings in Europe and about 11 in the United States. The price action in those 20 profit warnings in Europe has been between 10 to 20%, so an average of 10.6% drop on the day of those profit warnings. In the United States, expecting big rate cuts and even quantitative easing, but especially the window of liquidity that banks are accessing, the Federal Reserve continuing to pump liquidity, those 11 profit warnings have generated a drop of less than 6% and median level. So it shows how important it is to discern fundamentals and to something that you always talk about when I look at your videos, etc., which is how important it is to avoid traps in an environment in which you need to be aware of the monetary excess as a driver of markets, but you need to also be aware that there are very large traps when you look at the composition of what drives performance in markets. In the case of the S&P 500, the seven fantastic ones, no, things like that. But it's also important to remember in this case that when we look at the macroeconomic environment, usually what happens is that investors look at markets, they see that markets are going up, they understand that valuations are expensive and that the drivers of that performance are actually the ones that are seeing the largest multiple expansion. However, what I think is also very relevant is that the dangerous thing, and the reason why you have to pay attention to macroeconomics, is to then decide to put your money in the most cyclical stocks or in the most cyclical assets, because then you get something like what happened in 2023. You suddenly see, oh my God, why are commodities dropping like a stone? Well, those do reflect more significant element of the reality of the industrial production. So what we're seeing, 23, was if you divide the year in three, we had a period in which net liquidity in markets was going higher, and that drove multiple expansion. Then net liquidity started to drop, and that generated a correction. And finally, in the last part of the year, a huge recovery in markets that actually drove it back to all-time highs, precisely driven by massive liquidity injections. So the important thing also is to avoid the narrative of believing that central banks are being hawkish. A couple of rate hikes is not being hawkish. What we have seen is what it is to be hugely accommodative.
Mm-hmm. Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.